the member countries of the Organization of Islamic Countries. Here you can see again this kind of correlation, but with a small difference, that here it's basically the per capita income in the OECD is basically 10 times the averages that we're putting here. You're saying $20,000 to 100,000, here $2,000 to 10,000. And by this measure, N2 to GDP, or the other measure of financial intermediation and deepening that you can consider, which is basically credit to the private sector as a percentage of GDP, you can see this kind of correlation. Some tests of causality have been made as well between financial deepening, financial intermediation, and the growth of GDP per capita. We have seen this kind of strong correlation, and that the causality is running from finance to growth, and from growth to finance. Good references on that, of course, have been developed by many economists, including Levine and others. But what I'm trying to demonstrate here, that whatever is happening on that chart of the OECD countries, you need more and more of it to happen, but with more stability, with less crises, with more resilient path of development than what has been seen in the OECD side. Then another figure that I like to share with you, it's about the financial inclusion. So the World Bank, with the support of the Gates Foundation and Gallup, started to make this exercise in trying to understand what's happening in the demand side of the financial markets. And here we collected data from 148 countries. And the data is basically asking people, how do they save? How do they get money if they want the money? How they manage to pay for their transactions using the payment system? And how they are considering means and ways of risk management and risk mitigation if they have access to insurance or its alternative, takaful. Here it's basically the questions that we're raising is basically for conventional finance. And the evidence is really staggering. And the evidence is showing us that 2.5 billion people in the world are unbanked. This is roughly speaking 50% of the population of the adults in the world are without financial services. 75% of the world's poor do not have any access to finance. And they face this very big challenge today. And as I was sharing with colleagues, friends and scholars and students at INCEIF, is it new really to say that people are not with financial services? Is it new in a country like Malaysia or in the Arab countries? And of course, I'd like to recognize the presence of His Excellency, the Ambassador of Egypt to Malaysia. And he knows very well what I'm talking about here as well, from a practical perspective. That well, it has been really an issue that people do live their life may end as well without having any kind of access to banks or to insurance services. But at the same time, they have their arrangements. In the past, it used to be easy. From the informal sector or from the extended families, you can really borrow, you can invest, you can have some payments in cash. You can't really live your life without a financial system service whatsoever. But today, with urbanization, with the extended families are facing a great deal of challenges, with the problems as well that the informal sector as a last resort is very much being compromised as a way of getting finance from. It is not easy to get money from the informal sector because some people say, well, you can get it by an easy access. It is not really with an easy access because you are charged heavily in the informal sector. And at the same time, you need a different kind of collateral. you need a social collateral. You need somebody to provide some sort of guarantee, implicit or explicit guarantee for your transaction. But urbanization and other challenges making that kind of access very much complicated. So when you see this kind of a challenge, that you have 2.5 billion and more without access to finance, and they need some decent funding for their investments or for their own consumption, and you see, well, can financial transactions based on Islamic Sharia help in bridging gaps in finance? And here is basically a question that we need to answer. So here in the enhancement of financial inclusion based on Islamic finance principles, you can see really that there are some roles for the Islamic finance institutions, but some recent work by the CGAP, which is basically the consultative group to assist the poorest, one of the partnerships of the World Bank, it's saying that only 300,000 clients are currently being served by Islamic microfinance institutions. So there is a great deal of work needed in the future. In the Middle East and North Africa, there is approximately 4.5 million entrepreneurial poor who lack access to financial services. But of this number, there is less than 3% are being served by formal financial institutions. So there is a great deal of work needed in this front, great deal of opportunities, more institutions needed, and more transactions based on conventional finance or Islamic finance for those who are pushing and keen to have it need to be developed. But you can see as well that there is a role for other means and ways of providing funding, especially if you are going to be providing funding for those who are not able to get the financial transactions at the market level, especially if they are using it for consumption. What is the role of zakat, sadaqat, qard al-hasan, and waqf in all of that? There's basically some current research in these areas. And then the third aspect of Islamic finance, or the roles of Islamic finance, don't forget that I started by just sharing the deepening of financial intermediation, enhancing financial inclusion, and here the role of Islamic finance in strengthening financial stability. We made some comparisons between the performance of conventional banks and Islamic financial institutions. Many pieces of work, some of them are coming from the IMF, others are from the World Bank. And we have seen the following. First, that there is a consistent evidence of higher capitalization of Islamic banks. And we have seen as well that the conventional financial institutions are less resilient than the Islamic financial institutions. I'd like to refer here, as I put it in the premise, to a recent piece by Asli Kunta and others from the World Bank who made these comparisons. So there is a great deal of support to the fact that the financial institutions based on profit and risk sharing mechanisms could be more resilient in the time of crisis compared to the conventional financial institutions. And here, this could be really relying more on the following, that as I said at the beginning, that the Islamic financial institutions are based on profit and loss sharing. There is a close link between the real economy and the financial sector, and there is a stronger affirmation of property rights and contract enforcement, and there is an emphasis of morality and ethics in business conduct, and the advocation of sharing of risk and reward is there across the board. So this is basically the background so far. If you look into the future, there are two sets of matters that you need to consider. A set of opportunities and a set of challenges. Let me share with you what we consider as a group in the bank, and mentioning that we are not a small group now. There is a working group on Islamic economics and finance that was established in the World Bank to study and provide technical assistance and support in this growing area. So now we see the following. We see the commodity boom. We see a quality improvement in the financial services. Again, quoting many of the leaders of the industry here in this country, in Malaysia and in others, that the improvement of quality because of competition, because of the enhancement of services, have been attracting Muslim and non-Muslim alike to the services. And there is a growing interest by conventional banks to open up Islamic finance windows, and there is as well a new interest in developing Sharia-compliant indices in the capital markets. So here's the commodity boom. You can see on the right-hand side, if you take the Gulf Cooperation Council countries, and you see their increase of current account balances during the last 11 years or so, and you see that link with the increase of the oil prices from very low averages at the beginning of the decade to the estimates of averages of $100 plus recently. And there are, of course, as you know, expectations of more increase in the prices. These countries managed to have sovereign wealth funds, and you can see that if you take a kind of a snapshot on the sovereign wealth funds in the world, you can see some of the countries from the Gulf, Kuwait, United Arab Emirates. You might be surprised to see that Qatar doesn't have a very big figure here, but because of the classification of the sovereign wealth funds, they may have their own sovereign wealth fund operations, but not classified by the sovereign wealth fund institute as such. But there are huge investable funds in the sovereign wealth funds. Many of them are affiliated with members of the OIC. And the quality improvements I just mentioned, it's because of the competition, because of the new instruments that have been developed, it's because of the kind of links that are being established more recently with the real sector demand. And I think it's very much the case today that you can really see the industry is trying to abandon this kind of simple emulation of conventional financial vehicles. I think this had been the case in the early years of the 1970s and the 1980s. Wherever there was something in the conventional financial system, somebody's trying to be engaged in re-engineering an alternative in the Islamic financial system. Now we are seeing this kind of development, innovation, but based on real demand for it, and there is less emulation of whatever is there in the conventional system. This doesn't say that the emulation doesn't exist, but there is less of it than it used to be in the past. An interesting reference here is basically with some good constructive criticism by Dr. El-Gamal of Rice University, that which is providing an interesting challenge of this kind of automatic reverse engineering of activities and instruments by the Islamic financial institutions. And as I mentioned, there is a great deal of opening up of branches and windows by conventional multinational institutions. With some perspective, you can really consider today that if you want to have access, to Islamic finance, you can find it through more than 40,000 of outlets and branches across more than 70 countries. This doesn't mean that all of these branches are offering full-fledged services, but if you are anywhere in these 70 countries and you want to have an Islamic finance product, you can have it. And the last point on this is basically on the development of indices, the S&P indices, the Dow Jones indices. There is more than 30 indices based on the S&P approach, more than 40 based on the Dow Jones, that have all of these useful indicators for investing opportunities in companies claiming to be following the Islamic law or Sharia. But well, life is not about opportunities. Life is not about the positive aspects, but it comes with the exciting challenges. And I'm here for those who are interested in the field of Islamic finance by studying the instruments or the regulations or the operations, or those who are working in the industry, they really find a good opportunity in dealing with these challenges and providing solutions to them. The challenges are, could be summarized as follows: 6 main challenges: improving the regulatory oversight, rebalancing tax treatment, strengthening the insolvency frameworks, promoting standardization, ensuring adequate liquidity for long-term financing, and establishing sound risk management practices. Well, using my old academic hat, I can still see a good opportunity for master degree students, PhD students, and for researchers and scholars to develop our understanding of all of these areas, again with an emphasis on providing solutions, not just to provide a diagnosis of the problem. On the improvement required for the regulatory oversight, you can really see that there had been some progress made in the regulatory framework, but there are more requirements in this area. I can make a distinction between few approaches. One of them is basically with minimal alterations in the regulatory framework to encourage more presence of Islamic finance, like the approach adopted in the United Kingdom, or to have a kind of a dual approach or 2 tracks for business. One of them is for conventional finance and the other for Islamic finance, like in the case of Bahrain and Oman, through which it prevents the conventional financial institutions to have Islamic windows, to have full regulation for both tracks of finance. But we need more of work in this area, and the kind of collaboration we're seeing by different bodies in this area, including the IFSB, AOFI, and others, is very much welcomed in this regard. Another practical consideration is basically the tax treatment. In many countries, we can see that there is a great deal of bias towards the debt-based financial transactions. And conventional debt often receives advantageous tax treatment, encouraging leverage, and while the Islamic financial products may face double taxation. We can see that this country, Malaysia, have done good work in improving the standards and improving the kind of environment that both instruments are competing in, and to establish a kind of a level playing field. Another example is coming as well from Thailand, including some tax changes for sukuk issuance. And as